Welcome to the Taxation Chapter 12 online tutorial. Let's jump into the main topics for Chapter 12. Now, Chapter 12 is going to focus on corporate income tax. And we're going to first look at how do we calculate net income for tax for a corporation. Then look at how do we calculate taxable income. And then we're going to look at how do we calculate the federal Part 1 tax liability, once again, for a corporation. Now, when calculating net income for tax purposes, most corporations will start with their accounting net income. So the corporation would have prepared their GAAP financial statements and they would use their net income from their income statement. That would be the starting point. Once we have the GAAP or accounting net income, we have to make some additions and some deductions to get to net income for tax purposes. So what are some common additions that we make from accounting net income? So some of the common additions would be income tax expense. Now we would have deducted the income tax expense when we were calculating our accounting net income. And income tax expense is not a deductible expense for tax purposes, so we have to add it back. Another common addition would be accounting amortization. We are not allowed to deduct accounting amortization for tax purposes. What we'll see later on the next slide is that we can deduct CCA though. So accounting amortization, not an allowable deduction. And because it was deducted when we were calculating our accounting net income, we have to add it back for tax purposes. Now, accounting losses on the disposition of capital assets, those accounting losses we would have calculated by taking our proceeds of disposition minus our book value of that capital asset, and that accounting loss would have been a reduction to our net income. Now, we are not allowed to deduct accounting losses on the disposition of capital assets. However, what we'll see later on that we can deduct allowable capital losses. Remember those special rules for capital gains and capital losses? Only 50% amounts are included. And once again, we can only take the excess of our taxable capital gains over our allowable capital losses. So any accounting losses on the disposition of capital assets have to be added back. Also, warranty expenses. Now, for accounting purposes, we record our warranty expense on an accrual basis. What that means is that we may not have actually made any actual expenditures for warranty, but we would have accrued the warranty expense for this year. Once again, that is not allowed for tax purposes, so we have to add it back. We also have to make adjustments for meals and entertainment. 50% of meals and entertainments that were deducted in accounting net income, we have to add back 50% that is not deductible for tax. And club dues that were deducted in our accounting net income, 100% of those amounts have to be added back because none of those are allowed for tax purposes. Moving on. Charitable donations. Now, we have to add it back when we calculate net income for tax purposes, but what we'll see later on is that we can make an adjustment for charitable donations when we calculate taxable income. Now, this is the excess of taxable capital gains over allowable capital losses. What this means is that we have to adjust for the accounting losses and accounting gains. Those are the 100% amounts on the disposition of capital assets. But what we do need to do for tax purposes is take the taxable capital gains, the 50% amount, subtract the allowable capital losses, the 50% amount, and any excess we added back for tax purposes. Now, if we have more allowable capital losses than we do taxable capital gains, remember we said that those additional amounts of losses over the gains, those are net capital loss carryovers. We cannot deduct the excess of the losses over the gains this year, but we can carry them over as net capital loss carryovers. Also, any recapture of CCA. Now, recapture of CCA means we took too much CCA, and so we have to add it back for tax purposes. And also any tax reserves that were deducted in a prior year. Now, we learned in an earlier chapter that tax reserves, we get to deduct the current year amount, but we also have to add back last year's amount. So if we deducted any tax reserves last year, we have to add them back this year. So those are a list of some common additions to get to net income for tax purposes. Let's move on to the next slide. What about common deductions? So starting point again is accounting net income. We add those additions that we saw on the last slide, and we also get to take some deductions. So what are some common deductions? Well, accounting gains. So if we included any accounting gains in our accounting net income, we subtract those when we calculate our net income for tax purposes. Now once again, on the previous slide, remember accounting gains, accounting losses on capital assets, only 50% of those amounts have to include it. So we already adjusted for that on the previous slide when we had the excess of taxable capital gains over our allowable capital losses. The next item is CCA. we get to deduct capital cost allowance for tax purposes, so that would be deducted when we calculate our net income for tax. Any terminal losses. Now remember, terminal losses means that we took too little CCA before we disposed of the depreciable asset. So any terminal losses, which is unique to tax, we get to deduct those. Any current year reserves. Remember on the last slide we had to add back last year's reserve, and we again have to calculate this year. Are we allowed to deduct any reserves this year? If we are, we can deduct those when we're calculating our net income for tax purposes. Moving on, actual expenditures on warranty cost. Now remember on the last slide we had to add back the accounting accrual amount for warranty expenses. However, we get to deduct our actual warranty expenditures for tax purposes. Any ABLs, allowable business investment losses. Now remember from our earlier chapter, ABLs are losses on the disposition of small business corporation shares. Once again, that's unique to tax. So if we have any ABLs, we are allowed to deduct those for tax purposes. And that's going to bring us to our net income for tax purposes. Now there are a lot more additions and deductions. These are just some of the more common ones. So look through your textbook and read through the list for a complete list of additions and deductions of how to arrive to net income for tax purposes. Now moving on to the next slide, how do we calculate taxable income? Well, once again, we take our net income for tax and we get to make certain deductions. Now the first one we're going to talk about is those charitable donations. Now remember we said we had to add those back when we calculate net income for tax purposes. We do get to deduct charitable donations when we're calculating our taxable income, but charitable donations are limited to 75% of our net income. So that's why we had to calculate our net income for tax purposes first before we could determine if we were allowed to deduct all or only part of our charitable donations. Any amounts that we cannot use this year, we can carry forward for 5 years. And once again, charitable donations, you add them back when you're calculating your net income for tax purposes, but you get to take a deduction that is limited to 75% of your net income when you're calculating your taxable income. Moving on, Canadian source dividends. Now remember, dividends are paid after tax. So if you're a corporation and you have investments in another corporation and you receive dividend income from that investment, the payer corporation would have already paid corporate tax on that amount before they paid their shareholders dividend. So the government doesn't want to tax the dividends twice at the corporate level. So a corporation that receives Canadian source dividend gets to deduct those when they calculate taxable income. And also any loss carryovers. So if the corporation has any net loss carryovers or non-loss carryovers from previous years, they can make those deductions when they calculate taxable income. So that's how we get to taxable income for a corporation. Moving on to the next slide, let's look at a simple example. We have ABC Corporation, and here is their net income from their income statement, $100,000. They also included in that amount is a $10,000 gain on the sale of land. Now this sale of land is considered a capital gain for tax purposes, but that $10,000 was included in their net income on their income statement. Also in the net income amount was a $5,000 amortization expense. They also deducted charitable donations of $2,000 when calculating their net income on their income statement. And included in that $100,000 is also dividend income of $3,000 from taxable Canadian corporations. We're also told that ABC has calculated their CCA, and it is $4,000 for the year. And they also took some reserves. Last year they deducted a reserve of $2,500, and this year they calculated the reserve, and the amount they can deduct is $1,500. The company also has net capital loss carryovers of $15,000. Now, we need to calculate the company's net income for tax purposes and also taxable income. So pause the video now. You may want to review some of the previous slides to determine how we calculate net income for tax and how we calculate taxable income for a corporation. So pause the video now, and then when you're ready to check your answer with the solution, then resume the video. Okay, let's move on to the next slide and look at the solution. So the net income according to the income statement was $100,000. So that's our starting point. Then we have to add back amortization expense. We cannot deduct amortization expense for tax purposes. We also have to add the taxable capital gain. Remember the gain on the sale of the land? It was $10,000. Well, only for tax purposes, only 50% of that is taxable. So we have to add the taxable capital gain of $5,000. What we'll see later on is that we get to deduct the $10,000 accounting gain further down. But for now, we add the taxable capital gain. Only 50% of that gain is taxable. Those charitable donations, we have to add those back. We get a deduction later on when we calculate taxable income, but for calculating net income for tax purposes, we have to add those back. We also have to add back last year's reserve. Now those are the additions. What about deductions? Well, we get to deduct the accounting gain. Remember we said that we only get taxed on 50% of the gain on the sale of the land. So we remove the accounting gain on the sale of the land, and above we added back the $5,000 that we're taxed on, only 50%. We also get to deduct CCA for tax purposes. And the current year reserve that we calculated of $1,500, we get to deduct that as well. So that's going to get us to net income for tax purposes of $99,000. Now, net income for tax purposes is not what we're taxed on. We have to now get from net income to taxable income. So let's move on to the next slide. Net income for tax purposes is $99,000. We get to deduct our donations. Now remember, the charitable donations are limited to 75% of net income, but because our net income for tax purposes is $99,000, we are able to deduct the full $2,000 of charitable donations. Also, the dividends from taxable Canadian corporations. Remember we said that if you're a corporation and you're receiving dividends from another Canadian corporation, the other Canadian corporation has already paid corporate tax on that. So the government doesn't want to tax that income twice at the corporate level. So you as the recipient of the dividend do not get taxed on that. So you get to deduct the $3,000 when you're calculating your taxable income. As well, the net capital loss carryover. So the net capital loss carryover, even though we had a larger amount, we can only deduct it against taxable capital gains. And remember, our taxable capital gain, the 50% amount on the sale of the land, was only $5,000. So we can only use $5,000 of that net capital loss carryover. And that's going to bring us to taxable income of $89,000. So that's how we get from net income for tax purposes to taxable income. Moving on to the next slide, let's talk about stop-loss rules. Now, stop-loss rules are something that are unique to corporations. And let's just go through an example. Let's say that this corporation buys one share of another corporation at $10 on June 30th. On the next day, they receive a $1 dividend from the ownership of that share. Now remember, we said that when a Canadian corporation receives dividends from another Canadian corporation, that dividend is tax-free. They don't pay tax on that because that's a deduction when they calculate taxable income. So they pay $10 for this share. The next day, they receive a $1 dividend. And usually when a corporation pays dividends, they're paying out some of their retained earnings. If they pay a cash dividend, that's going to reduce their cash. So usually what happens to the price of the share is once the dividend is paid, the price of the share goes down. So let's say on the very next day, the share price goes down to $9, and the company that owned the shares sells the shares for $9. Now they have a capital loss of $1. So they received a $1 dividend tax-free. Because they bought the share for $10 and they sold it for $9, they now have a capital loss of $1. Now once again, only 50% of that is allowable, but they basically received $1 tax-free, and now they have a capital loss which they can use, 50% they can use against taxable capital gains. So this would actually give a very favorable result. They're not taxed on the $1 dividend, and they also now have a capital loss. So in order to basically remove this favorable situation, the government has implemented these stop-loss rules. And what it says is that the capital loss of $1 is reduced by the amount of the dividend received if the shares were owned for less than 1 year, or, now this is an or statement, so either could be true for the stop-loss rules to apply. The company owned the shares for less than 1 year, which in this example it did, or the corporation owns more than 5% of the payer corporation, the company that's paying the dividends. So in this example, because it was owned for less than 1 year, the capital loss of $1 is reduced by the $1 dividend received, so the capital loss is 0. So that is an example of the stop-loss rules. Moving on to the next slide, let's talk about another situation where a corporation is allowed to convert otherwise deductible dividend income and otherwise deductible net capital losses into a non-capital loss. Now remember, net capital losses can only be used against taxable capital gains, whereas non-capital losses can be used against any type of income. So this is allowing a corporation to convert those net capital losses that they can only use against taxable capital gains into non-capital losses, which they can use against any type of income. So let's go look through an example. This corporation has a net capital loss carryover balance of $50,000. They can only use that against taxable capital gains. Let's say in the current year, they calculate their net income for tax purposes, and that includes $5,000 of Canadian source dividends, taxable capital gains of $5,000. So currently, their net income for tax purposes is $15,000, but the company also has a business loss of $40,000. Now remember, net income for tax purposes has to be 0 or positive. It can never be negative. So the company cannot use up that full $40,000 loss. It can only use up $15,000 to reduce the Canadian source dividend and taxable capital gain to 0. So $25,000 of that business loss is unused. That becomes a non-capital loss. So this company's net income for tax purposes is 0. Now to get from net income for tax purposes to taxable income, we can make those deductions for Canadian source dividends, for donations, and also loss carryovers. But because this corporation already has net income of tax for 0, it cannot deduct the Canadian source dividends of $10,000, and it cannot deduct the net capital loss carryovers of $5,000 to offset the $5,000 taxable capital gains. So the taxable income will be 0 as also, because you cannot have negative amounts. So this seems unfair for this corporation. So let's move on to the next slide, and let's just recap what we know. This company has net capital loss carryovers of $50,000. Their net income for tax purposes includes that dividend of 10, taxable capital gains of 5 and the business loss of 40,000. And once again, they can only use 15,000 of that business loss in the current year, so 25,000 is unused. So their taxable income and their net income for tax is 0. Now let's take a look at what they were not allowed to deduct. They were not allowed to deduct the dividends of 10,000 to arrive at taxable income, and they were not allowed to deduct the net capital loss carryover of 5,000 to offset the taxable capital gain to get to taxable income because their net income was already 0. So what the rules allow is that if we take a look at their net capital loss carryover first, the net capital loss carryover is 50,000. They could have used up 5,000, but they couldn't. So what they can do then is they can remove 5,000 from the net capital loss carryover balance, and that's going to bring them down to 45,000, and they can transfer that to their non-capital loss balances. Now the non-capital loss, the very last line here, they had 25,000 of unused losses, of business losses this year, so that's where the 25,000 comes from. They can add the 5,000 that they convert from a net capital loss carryover to a non-capital loss carryover, and that 10,000 of Canadian source dividend that they would have been allowed to deduct when calculating taxable income, but they weren't able to deduct it because their net income for tax was 0, they get to include that amount in their non-capital loss carryover balance. So their non-capital loss carryover balance includes the 25,000 of the business loss that they couldn't use up this year, the conversion of the 5,000 net capital loss to a non-capital loss, and the 10,000 of the Canadian source dividends that they could not deduct this year. So their non-capital loss balance is now $40,000. So that's an example of how a corporation could convert the dividend amounts and the net capital losses that they weren't able to deduct this year into non-capital losses. Moving on to the next slide, let's take a look at how we calculate federal Part 1 tax. Now once again, we're just going to focus on the federal component of corporate tax in Chapter 12. Now federal tax is a little bit different from individual tax. The way that the federal tax works is that there's a federal corporate tax rate of 38%, and that's the basic rate. Now it seems rather high, but there are a bunch of deductions that can lower this 38%. The first one being the abatement. Now the federal tax abatement of 10% is basically reduces the 38% by 10% to get us to 28%. Now this abatement is basically saying, well, since the provinces are going to be taxing the income as well, we're going to reduce the federal amount by 10%. So if the income was earned in a province in Canada, then that income gets a reduction of 10% at the federal level. Now, if the income was not all earned in a Canadian province, maybe some of it was earned outside of Canada, then that amount of income would not be subject to this 10% abatement. But let's assume that the income was earned all in Canada in a province. So our rate goes from 38% minus 10% to 28%. At this point, we get to deduct any foreign tax credits. If we earned money in a foreign country and we pay tax in that foreign country, the corporation gets a foreign tax credit. That's going to reduce the amount of federal tax they pay. Now, there's also a small business deduction. This is only available to CCPCs, Canadian Controlled Private Corporation. Now, the small business deduction is a reduction of 18%. So we were at 28% minus 18%. That's going to bring us down to a corporate tax rate of 10% on income that is eligible for the small business deduction. Now, once again, the small business deduction only available to CCPCs, Canadian Controlled Private Corporations. The 18% reduction is only on the lesser of three amounts. One, Canadian active business income. So the corporation, the CCPC, must have Canadian active business income. If the income is passive in nature, for example, interest income, dividend income, rental income, passive nature, that is not active business income, that would not be eligible for the small business deduction. So only Canadian active business income, that's the first amount. The second amount is the company's taxable income minus some adjustments for foreign tax credits. The third is the annual business limit of $500,000, less an amount that is given to associated corporations, and also reduced if the CCPC is considered a large corporation. We'll talk about what this reduction for large corporations is a little bit later, but CCPCs are given a business limit of $500,000 a year that is eligible for the small business deduction. Now, that $500,000 limit must be shared amongst associated corporations. Now, we're going to see associated corporations in a later chapter. So that would be the annual business limits, the lesser of those three amounts. So once again, that could bring the corporate tax rate at the federal level, 28% minus 18%, to an amount of 10%. Now, if the company has income that doesn't qualify for the small business deduction, moving on to the next slide, it may qualify for the manufacturing and processing profits deduction. Now, this only relates to income from manufacturing and processing, and this is a reduction of 38%. So you cannot get the reduction on the small business deduction and the manufacturing and processing profits deduction. So this 13% reduction is the lesser of two amounts: the manufacturing and processing profits minus the amount of income that was eligible for the small business deduction. So that's the first constraint. The next constraint is taxable income minus, again, the amount that was subject to the small business deduction, minus some adjustments for foreign taxes, and minus what we call aggregate investment income. We'll talk about aggregate investment income in a bit because that's going to come up in the next item. But if a company has manufacturing and processing profits, then that 28% could be reduced by 13%, bringing it down to 15%. Now, the next reduction is called the general rate reduction. Now, the general rate reduction is also a reduction of 13%, just like the manufacturing and processing profits deduction above. Now, for most companies that operate in Canada, the income that is subject to the manufacturing and processing profits deduction will also be subject to the general rate reduction. But once again, you can't have both, so you sort of follow this order. Now, because the reduction of 13% is the same, in most provinces, it's not going to matter whether you take the deduction under the manufacturing and processing profits deduction or the general rate reduction. It only matters at a provincial level. There are some provinces that still provide companies that have manufacturing and processing profits greater benefit. And so that's why we still have this deduction at the federal level, because it could make a difference at the provincial level, but at the federal level, it doesn't necessarily make a difference because the 13% reduction for the manufacturing and processing profits is the same as the 13% reduction for the general rate reduction. So what is this general rate reduction? The general rate reduction is a 13% reduction, and the way we calculate that is on full rate taxable income. So what is full rate taxable income? Full rate taxable income is taxable income minus the amount that was eligible for the small business deduction minus the amount that was eligible for the manufacturing and processing profits deduction. So you can't get the deduction twice. It's either on the small business deduction first, which is the greater reduction, then we go to the manufacturing and processing profits deduction, and then anything left over would be eligible for the general rate reduction. However, aggregate investment income is not eligible for the general rate reduction. Now, what is aggregate investment income? Now, normally you think about aggregate investment income as just passive income. However, we refer to this as aggregate investment income because it excludes dividends from other Canadian corporations. So aggregate investment income is basically investment income, passive income. However, it excludes dividends from Canadian corporations. So that's sort of the ordering of calculating federal Part 1 tax. Now, let's go through a simple example on the next slide. Let's say ABC, who is a CCPC, has taxable income of $200,000. Of that $200,000, $50,000 is considered active business income. Now, none of the income relates to manufacturing or processing, and none of it is aggregate investment income. So let's just keep this example really simple. $200,000 of taxable income, $50,000 of that is active business income, and none of that income is related to manufacturing or processing, and none of it relates to aggregate investment income. All the income was earned in Canada, and ABC is not associated with any other corporation. Let's calculate ABC's federal Part 1 tax payable. Now, you might want to just jot down the information above before we go to the next slide and look at the answer. So just quickly jot down that answer, the information above, pause the video if you need to, and then resume the video and we'll look at the answer together. So on to the next slide. Here is how we calculate federal Part 1 tax. Now remember we said that the federal rate is 38%. That's the top row. So the $200,000 taxable income, we multiply that by 38%. So that gives us a federal tax liability of $76,000. Now, because all the income was earned in Canada is attributable to a province, so we get that 10% abatement, and that's going to reduce our federal tax, Part 1, by $20,000. Essentially, we can take $200,000 times 28%, and we'll get what's on the third row, the $56,000. Now, the small business deduction is a reduction of 18% times the lesser of three amounts. Remember, the lesser of three amounts, active business income, which is the $50,000. The second amount was taxable income, making some adjustments for foreign taxes. Now, our taxable income was $200,000, which is more than the $50,000. So the lower of those first two is still the $50,000. And the third amount was the annual business limit of $500,000 minus any amounts that were given to associated corporations. Now, ABC has no associated corporations, so they get that full $500,000. Now remember, there was still that reduction for a large corporation. We'll talk about that later, but let's assume there was no reduction for a large corporation. So it's the lesser of $500,000 active business income, taxable income $200,000, or the annual business limit of $500,000. The lesser of those three amounts is the $50,000. So the small business deduction, $50,000 times the 18%, that's going to reduce the federal tax by $9,000. Now moving on to the next row, the manufacturing and processing profits deduction. Now remember we said none of the income was related to manufacturing and processing, so there's no deduction there. However, the general rate reduction is a 13% reduction to full rate taxable income. So full rate taxable income is taxable income, $200,000, minus the income eligible for the small business deduction, $50,000. That's going to leave us with $150,000. That gets the general rate reduction times 13%. That's a reduction of $19,500. So this company's federal Part 1 tax payable is $27,500. Now there is another way of doing this, but only for this simple example where we don't have, let's say, foreign tax credits, where we don't have the manufacturing and processing profits deduction. So let's look at this other way of doing this. What we could do is say, let's figure out how much income is eligible for the small business deduction. That was only the $50,000. And that $50,000, we're only going to pay tax at a rate, federal tax at a rate of 10%, 38% minus the 10% abatement minus the 18% small business deduction. So that only leaves 10%. So 50,000 times 10%, we only pay tax of $5,000 on the 50,000 active business income. On the remaining 150, we get the general rate reduction. So 38% minus the 10% abatement minus the 13% general rate reduction, that's going to leave a rate of 15%. So on the remaining $150,000, we pay 15%, which is $22,500, and we're still going to arrive at federal Part 1 tax payable of $27,500. Now, we can only do this method for simple examples. if we had foreign tax credits, more adjustments for foreign taxes, this simple method may not work. Let's move on to the next slide. Let's talk about the elimination of the small business deduction for large CCPCs. Remember, we said that for the small business deduction is the lesser of three amounts, and that third amount was the annual business limit of $500,000 less any amounts allocated to associated corporations, and also a reduction for large corporations. So let's talk about what this is. The annual business limit of $500,000, let's assume there's no associated corporations, but we have to make a reduction for large corporations. So let's look at the formula for this reduction. Now, the reduction is calculated as A times the fraction of B over 11,250. So what is A? A is the corporation's share of the $500,000 annual business limit. If there's no associated corporations, then A would be $500,000. B is 0.225%, or putting it into decimals, 0.00225 of the excess of the previous year's total taxable capital employed in Canada over $10 million. So what is taxable capital employed in Canada? Well, the textbook defines this as the gap determined debt and equity capital of the corporation less debt and equity investments in other corporations. So we think about the gap determined debt and equity capital of the corporation, all the debt, all the equity, all the liabilities, all the shareholders' equity, that's essentially the same as total assets. Remember our accounting equation, assets equals liabilities plus shareholders' equity? So another way of looking at that first part, gap determined debt and equity capital of the corporation, you can sort of think about that as your total assets less debt and equity investments in other corporations. So that is the definition of taxable capital employed in Canada. Only the amount over 10 million times 0.00225 would be the B. So also note that when taxable capital employed in Canada, when that number reaches $15 million, now this is for the corporation plus any associated corporations, then that's going to eliminate the entire small business deduction. So any large CCPCs that have taxable capital employed in Canada of 15 million or over, including those of associate corporations, would not have any small business deduction available. So let's look at this example. Assume that the previous year's taxable capital employed in Canada was 15 million. So how would that work in our reduction formula? Our reduction formula, A is 500,000 times B, the amount over 10,000, the amount over 10,000 is the amount over 10 million is 5 million times 0.00225. That's going to result in 11,250 over 11,250, which is basically 1. So 500,000 times 1 is 500,000. That is the reduction amount. So remember, this is the amount that the small business deduction is reduced by. So the 500,000 minus the reduction of 500,000 leaves 0 available. Let's take a look at this example. Let's say that ABC's taxable capital employed in Canada last year was 12 million. Let's say ABC is not associated with any other corporations. What is the reduction to the annual business limit of 500,000? So pause the video now. You might want to refer back to the previous slide for the formula and then see if you can calculate what is going to be the reduction to the 500,000. And then resume the video once you're ready to check your answer. So pause the video now. Okay, let's take a look at the answer. Now remember, the reduction formula was A times B over 11,250. A is the corporation's share of the annual business limit. In this case, it would be the 500,000. And B is the 0.00225 times the excess of last year's taxable capital employed in Canada over 10 million. That amount in this example would be 2 million. So the reduction then would be A, 500,000 times 0.00225 times 2 million over 11,250. So if you work through that, we're going to get 500,000 times the fraction of 4,500 over 11,250. That's going to result in a reduction of 200,000. And so the annual business limit that would be available, the amount that would be available would be the annual business limit of 500,000 minus the reduction of 200,000. So this company would still have $300,000 available for the small business deduction. So that's how the reduction formula works for large CCPCs. And we would then use that 300,000 to determine the lesser of the three amounts available for the small business deduction. Now remember, the lesser of the three amounts, the first amount was the active business income, the second amount was the taxable income minus the adjustments for foreign taxes, and then the third amount in this example would be the 300,000. So that brings us to the end of chapter 12. Now there are some other topics that you should review on your own, so make sure you read through the entire chapter on your own. Do the extra textbook practice questions for extra practice, and that's going to bring us to the end of this tutorial. Good luck with your studies, and we'll see you in the next online tutorial.